When it comes to investing, overcomplicating things could mess up your portfolio and could result to a loss. We don't want that. We want gains and profits. So are you ready to learn how to beat the market at its own game? One Up on Wall Street by Peter Lynch is a thrilling guide that will teach you how to invest like a pro and achieve market-beating returns. He's one of the most successful fund managers in history. His investment philosophy, which is based on the idea that individual investors have a significant advantage over professional money managers. This is for anyone who wants to learn how to invest in stocks and achieve financial success. His approach is practical, down-to-earth, and easy to understand. He emphasizes the importance of investing in companies that you understand and have personal experience with, and of investing for the long term. So now, get ready to take your investment game to the next level. Our first key takeaway is determining the types of companies. Well, before you even start investing, you should first do your homework. This is by researching and analyzing each stock you will be investing in. By familiarizing yourself, you would have a better understanding as to what stocks you want in order to create a good portfolio. Now, Peter Lynch categorized companies into 6 types to understand better what he owned and why. First, the slow growers. These are usually large and aging companies. There's nowhere to expand and the price won't go up much, but are good dividend payer, which is a sure sign of a slow grower. It pays generous and regular amount of dividends. Now, companies pay more dividends when they can come up with new ways to use the money to expand the business. Since you buy these for the dividends, you should check if they pay regularly and whether they raise it. Check the balance sheet and find out what percentage of earnings are being paid with dividends. Now, this is the payout ratio. If it's low, then the company has a cushion in hard times. If it's high, then the dividends is riskier. Second, stalwarts. These companies grow faster than slow growers. These are the heavyweights such as Coca-Cola, Bristol-Myers, Procter & Gamble, the Bell Telephone Sisters, Hershey's, etc. But this is not exactly an agile climber. With growth of 10 to 12% per annum, they are great protection in economic recessions and depressions, but you should check the price first whether it's overvalued. Check its long-term growth and whether they are keeping it up recently, and if you plan to hold it forever, you should check how was the company during previous recessions and market drops. The third type is the fast growers. These are small, aggressive new enterprises that grow at 20 to 25% a year. These companies grow comparatively faster compared to the industry average or its competitors. If you choose wisely, this is the land of the 10 to 40 baggers and even the 200 baggers. But a warning, you should check whether the company has still room to grow, because there's a great chance for the fast growers to get hammered if they run out of steam, especially if their growth is not sustainable. The fourth type, the cyclicals, usually follow a rise-fall-rise pattern, rising and falling in a more predictable manner based on the economic cycle. Examples are the autos, airlines, tire companies, steel companies, and chemical companies are all cyclicals. It depends on the direction of the economy. If you're holding this stock, you should be updated about the supply and demand relationship. Fifth, turnarounds. These are no growers which from time to time are capable of rebounding. These are the companies that have been battered down or depressed. Turnarounds are some of the most exciting companies to look out for. Assess it. Can the company survive by the rate of its creditors? You need to check the balance sheet, its cash, debts, and for possible bankruptcy. And lastly, asset plays are companies which have been overlooked by Wall Street constantly, even though they sit on assets have some inherent value. Like Walt Disney, they weren't growing fast, but then they started Disney Channel, selling their products in Disney World and Disneyland, for example, Mickey Mouse and the other characters, and using their land for their hotel. In short, the company is loaded with good assets. So with this knowledge, you can have a better point of view as to what companies you would want in your portfolio. Now, before we head on to our next takeaway, one platform that can help you analyze and scan for potential companies to invest in is simply Wall Street. They have tons of data available for you, and it's so easy to understand. Imagine they give you graphs, comparisons, and valuations which are presented wherein a child can understand. And for those who are having trouble keeping up with the stocks they own, then this platform also does the job for you. They update you on the stocks in your watch list from earnings release, dividends, insider buying or selling, or if the company falls below your computed buy price. And speaking of buy price, if you don't know how to compute it, they also have a computation for you. But of course, a warning. Still do your thorough research about a company if it's really worth investing in or not. Don't just rely on the buy price alone. And there's more, they also have a portfolio tracker that lets you assess your portfolio's health. detailed returns, and a lot more. So if you want to try it out, you can head down below and sign up using my link. They offer their basic plan for free, and if you do avail of their paid plan using my link, you can get 30 and even up to 40% discount. So what are you waiting for? Level up your investing journey with Simply Wall Street. Now back to the video. Know the traits of a company which make it an attractive investment. Now, companies with a simple business model that is so easy to understand are more likely to be successful in the long term. This is because a simple business model is easier to execute and less likely to be disrupted by competitors or changes in the market. It should also have a strong financials, including a healthy balance sheet, consistent earnings growth, and high return on equity. It also must have a competitive advantage, meaning having such a strong brand, proprietary technology, or a dominant market position that can help a company maintain its position in the market and generate higher profits. And also one to look for is when company insiders own a significant amount of the company's stock. It's a good sign. This is because insiders are more likely to have a vested interest in the success of the company and can help align the interests of management with those of shareholders. It should also have growth potential of an above-average growth rate. A company that can sustain high growth for an extended period are likely to provide the best returns, and also a company that has a clear plan for growth, such as expanding into new markets or developing new products. By focusing on these key traits, you can identify companies with long-term growth potential and achieve market-beating returns. Third, avoid diversification. Peter Lynch coined the term diversification to describe the all-too common practice of over-diversifying one's investment portfolio. This means spreading your investments across too many different companies or sectors, diluting the potential for significant gains from a few well-chosen stocks. So instead of doing this, you should focus on building a portfolio of well-chosen stocks with strong fundamentals and long-term growth prospects. By avoiding diversification and focusing on companies that you fully know and understand, you can potentially achieve higher returns and benefit from the power of compounding returns over the long term. In other words, this approach to investing is all about quality over quantity and the potential for big gains from a few well-chosen stocks. Don't predict the market. Trying to predict the short-term market fluctuations is a losing game. What investors should be doing is to focus on the long term instead. This to avoid making impulsive decisions based on short-term market movements. Be careful in chasing after hot stocks and trends, as these investments are often overpriced and have limited long-term potential. Remember, no one can predict the market. Instead, focus on what you can control, which is invest in good companies with solid fundamentals and hold on to them for the long term. And speaking of long term, we go to our last point. Go for a long-term approach. A long-term investment strategy emphasizes the importance of holding on to good stocks for several years. This approach allows you to benefit from the compounding returns over time, which can result in substantial gains. Rather than trying to time the market and make short-term gains, focus on finding high-quality companies with strong fundamentals and hold on to them through market fluctuations, because successful companies will continue to grow and generate profits over time. By doing this, not only do you gain dividends consistently, when the stock price does climb, then you ride along with it. Unlike for someone who tries to predict the movement of prices and just ends up losing money consistently. However, since this approach requires a focus on the underlying fundamentals of a company, which can take time for the market to realize, you should be willing to be patient and disciplined in the face of market volatility. So in conclusion, this investment approach is centered around the idea of finding simple, easy to understand companies with a competitive advantage and investing in them for the long term. This emphasizes that you have to know what companies you invest in, the importance of doing one's own research, and avoiding the pitfalls of over-diversification. So with that, this ends this video for today. I hope you've learned something, and if it did, be sure to click the like button before you leave. And if you haven't tried Simply Wall Street, try it now. There's nothing to lose. It would really help you out in your investing journey. So thank you and see you in the next video.